think we're going to go ahead and get started here. Thanks everybody for coming to our session.
Can you guys hear us back there? Maybe you want to get close to the mic?
Yes. All right. You can hear us? Cool. All right. So we are a group from a public accounting firm named CBIZ, but we kind of do a variety of roles here. So my name is Denari. I work in business valuation, and more specifically, a lot of my time is dedicated to forming and valuing ESOP companies, and we'll get into those later in this presentation.
Tim Croushore, also valuation. My focus is more on transaction work, pre-deal, post-deal, estate and gift, wealth planning, anything where value is the question.
And I'm Fred Campos. I focus 100% of my time on mergers and acquisitions.
And then we also have some tax content in here as well. A tax partner on the West Coast was unable to make it, but we'll do our best as non-tax people to kind of try to bring the relevant stuff to what might be, you guys might be facing in the craft brewing industry. Relevant topics, we'll try to touch on those. But certainly not the experts on our end, but always willing to follow up with those that are. So we'll go ahead and get started here. So yeah, we're going to be kind of talking a wide range of topics, and if you guys have things on your mind as we're going through this, want this to be an interactive thing as much. Yep, come on in. Want this to be as interactive as you guys want it to be. We have a fair amount of content, but we're open to kind of discussing what you guys have on your mind if you have things you want to talk about. So generally we'll be talking valuation considerations in the industry. We'll look at kind of the M&A and industry trends in the industry. Like I said, we have some tax content, relevant tax content, and an introduction and a little bit about ESOPs and why they can be a fit in the craft brewing industry. So I think we kind of gave our intros here, so I'll skip through those. Kind of did the agenda just a second ago, so we'll move, I think, into just an industry snapshot. So I don't know, Fred, do you want me to take this, or you want to? All right, I'll take it. So, we have a lot of slides here, and we'll click through them. They've got various, graphics and charts, whether it's kind of industry as a whole. We have some stuff New York State specific, and a lot of it's going to tell a similar kind of trend of, obviously a lot of upward growth, call it 2010 to, COVID-ish time and into even the last couple of years, and then a little bit of a leveling off in the last 2 to 3 years. As you can see here, we have the industry data saying that there's a growth of really minimal growth projected over the next 5 years, with the total industry projected to reach $7.5 billion by 2029. As the industry and craft breweries themselves reach maturity, the landscape's gotten a little bit crowded, as I'm sure it's not news to all of you guys. And it makes organic growth and expansion a little bit harder. And there's been a fair amount of M&A activity. And I think that's the market's saying that is likely to rise in the future. Consolidation and things like that. As breweries or kind of groups that are going out and participating in this M&A activity are looking to reduce costs and expand kind of brand portfolio. The data is showing that breweries, obviously it's no secret, with a strong customer base, and then an array of downstream channels, whether it's brew pubs with food, bars, retail, getting into retail, just with a variety of kind of revenue streams are going to fare the best going forward. Obviously, there's been increased competition from other craft beverages, whether it's craft distilleries, wineries, ciders, seltzers, canned cocktails, THC-infused beverages, and all that, which 5-10 years ago it was not so much the case. Those are kind of earlier on in their life cycle compared to, the craft brewing industry. And then I threw this in here. This is, more of kind of unknown or very early stages, right? But the impact of tariffs on, aluminum, what that's going to look like in cause in terms of downstream effects. Our brewery's going to be able to pass through increases to the customer, and just how all that's going to shake out. Will there be some other way to adapt and kind of get around that? It's kind of all, very new and obviously recent months. So that's just something to monitor going forward. This snapshot here is just like sales volume and production volume. You can see here, again, kind of shows the trend we're talking about, a little bit of a leveling off in the last few years, but nothing, to the point where it's, we're not seeing a precipitous drop the last couple of years, and that's not what's forecast in the coming years, but just not that hockey stick growth that I think, the industry saw, from, call it 2010 on. This is, again, kind of tells a similar tale here. Off-premise alcohol sales, you can see craft beer there, kind of boxed in. Again, just slight kind of negative growth pattern there. And then, again, just kind of reinforcing that. We have the brewery count. The data is a little bit dated. It only goes out to 23. But again, just the total craft brewery, top line, including kind of all the, different types, whether it's regional, microbreweries, tap rooms, brew pubs, similar message to kind of what I've said over the last few minutes. You can see the openings have trended downward in the last 5 years due to that market saturation, and then the trend, unfortunately, of closings approaching or surpassing the number of openings in recent years. Here's a little bit of data for New York State specifically, with over 500 craft breweries. You guys are the second largest, have the second largest count in the country. Breweries per capita a little bit different there, right? It ranks kind of middle of the pack when you factor in population and all that. But you can see that the trend of openings through, again, the data stops at 2023 there, but a very solid trend of craft brewery openings in the state. So showing a strong market here. And this is, I don't know if we need to necessarily go over this one, a little bit more, just in-depth data to kind of show barrels produced. Again, similar trend of, kind of the upward trajectory and leveling off a little bit in recent years.
Can you go back one slide?
Yeah, sure. This one?
No, the other one. Just out of curiosity, because we see all these trends right now, tap room, brew pub, micro, regional. Who here would fall, let's say, in the tap room category? Okay, got 1, 2, 3. Brew pubs? Microbrewery? Okay. Regional? Okay. Go back one more. Those one slide, no, one more. One more? Yeah, there. I just thought it was interesting how tap room is the only one with a positive trend here. But at the same time, you saw that trend that was declines in the opening, right? But it's the only one that's showing a positive trend here up to 2023. We'll try to, as much as we can, I'll dive into the M&A side of it. Unfortunately, from an M&A standpoint, we don't have that level of disaggregation. But what I like about when you look at these trends is everything is unique to where you're at, right? You can generalize any of this data, and it's not a one-size-fits-all. So when you're looking at all this, try to focus on specifically what applies to you, and we'll try to do the same. But if you want to flip now to the M&A, okay. Do you want to keep going?
Yeah, either way. Yeah, you can take this, Fred.
Yeah, because the data that we have here from M&A standpoint, these are relatively big deals, right? You have August 24, acquisition of 4 craft brewers from Molson Coors, Hop Valley, Terrapin, Atwater, and Revolver. January 24, another one doesn't have the amount, right? It was paid for. It's interesting how you see Molson Coors divesting, right? It doesn't say who bought them, right? Who bought? Do you know who bought them?
Tilray. So they're.
Oh, Tilray, yeah. So the one thing about M&As, like, tend to be cyclical, right? You have, a few years ago, there's a lot of activity in this space, and then it starts to slow down. And then you start seeing either reselling them, or unfortunately, the bigger beer brands getting rid of the brands that they acquired, and now they're looking for something else. So it tends to be cyclical. It comes and goes in waves. So if you think for whatever reason you missed the wave, don't feel discouraged. It'll come back. Actually, yeah, a couple others there. October 23. Again, Tilray Brands brought 7 craft beers and 1 energy drink. Again, you see the trend again. Anheuser-Busch selling, Molson Coors selling. And you got the list there, Blue Point, a couple more recognizable brands there. 23 Carlsberg, well, that's Waterloo Brewing, 186 million Canadian dollars. Pretty decent multiple, 9.2 times EBITDA.
Yeah, I'll just chime in here. The multiples, unfortunately, as valuation people or M&A people, we like to look at data and try to compare, within the industry, different years, maybe different industry niches, things like that, and try to come up with, get things apples to apples and say, all right, so a specific client that we're working for, where do we think they fit in? Unfortunately here, from the data that we're able to get, the multiples are kind of all over the place and obviously in different parts of the country. So, I think to your point, Fred, it's really more of a, it's good to see this, just be aware of what's out there, but a lot of it's going to be very, company, brewery by brewery specific, what you're bringing to the table, who's in your market, the bigger players in your market, and just kind of what you said in terms of industry cyclicality.
Yeah.
Of who, is it a boon of bigger companies or regional breweries trying to buy up smaller ones, and it kind of goes in waves, like you said.
Yeah, I can tell you something like this is highly unusual. These are outliers, especially 43.6 times EBITDA. But yeah.
Yeah.
Okay,
Maybe you want to take these?
I get the fun part, talk a little theory here. And I'll confess, I'm from Los Angeles, so I have a little bit more of a West Coast orientation on this industry, but I'll do my best to fit it in. Effectively, when you're talking about valuation, the person doing the buying in your particular case, or when you're buying somebody else, you're going to look at a couple different things. Everybody likes to talk about multiples. We'll skip to the market approach first. But you saw 43 times EBITDA, and you saw 9 times EBITDA. We probably have deals in there 3 times and 4 times. So the question is, what's the right multiple? Well, the question might be, what's EBITDA? Earnings before interest, taxes, depreciation, and amortization. Sorry, I'll try to keep that acronym stuff to a minimum. Those multiples are all over the board because frequently the buyers aren't buying the EBITDA. They're buying your brand. They're buying, perhaps they're filling in a niche on an ale or a pilsner that they don't currently have filled in. You've got a great product. You become a strategic acquisition. They're looking at what they can do with your product, not so much what the multiple of your statistic is. And that brings us back to the discounted cash flow model, which is really the driver behind this. As a buyer, I'm looking at your information, looking at your product, looking at your brand, looking at your distribution network, and I'm asking myself, what can I do if it were mine? Can I push my product through your distribution channels? Maybe you've got great distribution. Cool. I can use that, and I can sell all my stuff with good product, lousy distribution. I now can push that all through. I'll pay more for, and the multiple of your EBITDA might be 100, I didn't really buy you. I mean, I bought your EBITDA, but that wasn't the point. The point was I bought something else. Understanding those value propositions is really important from your perspective. Do you have great equipment, a great brewmaster, quality product across the board, and you're getting into restaurants, you're getting into some of the grocery stores? That's a solid business proposition. That's a solid acquisition target for people that are not in that space where you are yet. So they're doing a make versus buy analysis. I can go out there, I can spend a couple of years, I can hire some folks, we can build it, or I can talk to you and buy your company and fold you in and give you the autonomy to go make it better even than it is now. So these two approaches. The discounted cash flow is a multi-period, project revenue, project expenses, come down to a kind of a free cash flow. Business is paying for itself, I can take the rest out, and then an appropriate rate of return, cost of capital, and pull all those numbers back to present value. More finance math than you wanted to talk about today. Again, I'm sorry for that, but that's the way the analysis works. We spend a lot of time in that space doing that work, refining the expense ratios, optimizing profitability, going through the risk analysis, debt, all those other wonderful things to kind of figure out a reasonable range of value for you guys. The market approach is much more straightforward. It is, if you can make multiples make sense, it's, the private equity guys are known for one question: what's your EBITDA? And then they'll take their look at it and they'll hit it with a 6 or a 7 or whatever their math tells them is the right number. They're not buying so much to consolidate you with a better, my product through your distribution channel. They don't have that. They're private equity. They just want to buy you as a position, help to make you better, and sell you again in 5 to 7 years. That's their model. So they're talking multiples of your statistic, where the discounted cash flow and a strategic buyer is really talking about what they can do with you in partnership. I can use your product through my distribution, vice versa, whatever it works out to be. So understanding what you're strong at, what you're good at, and what the buyer's going to be purchasing you for, why do they care about partnering up with you, helps you understand the value proposition from their perspective.
And Tim, I'll just want to add in, on all the market data that we have in here, the private equity data is very hard to come across. So a lot of that is, again, as Fred, outlined, it's, Molson Coors divesting some of the craft breweries, or a regional craft brewer buying a smaller one and things like that. So we don't have a lot of good data on kind of what those PE firms have been, have paid over the last several years. So again, just wanted to kind of fold that in there to this whole discussion.
Yeah, and the last approach up there is an asset approach. We're starting to see in California some of the smaller, less well-developed, less well-capitalized craft folks go out of business. And it's really turning into what kind of equipment do you have? You have a great facility with a decent lease. What can I buy? What's left at the end of the day? When it didn't work out for you, if we're talking a bunch of plastic stuff, it's not as good as if it's all stainless and all that. You know that world better than I, far and away. But that really is what it is. It's a liquidation approach. And that has a couple different variations as well. If it's your banker, it's liquidation in the sense of, let's take everything, wheel it out to the curb with a for sale sign, and put a for sale, and what cash can I get now? As opposed to, give me 3 months, give me 6 months. In a more orderly fashion, I can sell some of these things to the right people and maximize proceeds. So liquidation has a couple different scenarios as well. And really, those 3 approaches, income, market, and asset, are how any appraiser in the world values anything. Your watch, your house, your business, personal capital, whatever it is, we use one of those 3 approaches in some form or another. There's not any other way. My time? No.
Yeah, absolutely.
Oh my gosh.
Are
Yes.
you seeing a lot of private equity coming into the brewing market? Or do you feel like it's mostly like other strategic side?
More strategic on the strategic side, and Fred, chime in here whenever you want, but a lot of it is, they think, some of the private equity folks I've talked to that are in the consumer products and restaurant space, kind of adjacent squares, they're looking at this going, 10 years ago it was really hot, and we're probably past the peak, and we need to see where it settles. Maybe not where the bottom is, that's kind of a harsh thing to say, but we have a couple years of consolidation, we kind of ran real strong, now we're going to take a breath. After the breath, we'll see what we have to play with. And I'm not seeing private equity consolidating these guys up yet. I think that's probably a year or 2 away.
I think one of the reasons, and perhaps even the main reason why you don't see a lot of private equity coming in, is because private equity, they're really good at two things. One, they'll buy what they call a platform business. And then that's a decent size. And then they start adding others, right? And then they'll go through synergy / cost, there's some improvement, and they'll flip. The problem is, unless they have a presence in this industry, for them to come in and try to figure out the whole 2-tier, 3-tier system and distributor, so on and so forth, it's not for anyone, right? I don't have to tell you guys that. It's hard. So unless they have, whereas the strategic, that's their business, that's what they do. They're gonna add another brand to their distribution channel, right? So that's a huge barrier, right? A private equity can't just come in and say, well, don't worry about it. I know all distribution channels, I'm gonna get you in Southern Wines or whatever it is, and you're gonna be, golden. So I think that impacts quite a bit.
And there's a kind of a cultural aspect, and again, this is my LA bias coming out a little bit. I hear the word sellout when I'm talking to my friends in the business, where so-and-so sold to Anheuser-Busch or Molson or whatever, and they're sellouts. Because they've lost control, they've lost their brand, they're not craft anymore. So I mean, and I'll say it, you guys, all of us, have a little bit of we get a little prickly about stuff like that. We like to be who we are. We like to be independent, we like to make our product, we like to love our stuff, and we like to do it, we don't necessarily want to be coerced. So that's why we do what we do, because we don't want to drink coerced, we'd rather drink what we make. So that the industry has a little bit of proclivity toward not going private equity and not really, the roll-ups are a little bit different. Ballast Point, I know that, I've had those conversations with those guys a lot. They got to keep Sculpin the way they wanted it, everything else was subject to whatever Anheuser-Busch decided to do with the formulation. They weren't thrilled, but it was part of the deal, and, nobody was really that thrilled. They liked the money, but they didn't like the way the transaction went down. And I think that sentiment is consistent, at least I would assume across the industry, it is in my part of the world. We take pride in what we do. You guys take pride in what you do. And the thought of giving control to private equity so they can help us with a platform formulation and roll it out into every Safeway in the world, and Kroger, and then they'll flip it in 5 years and we'll get another bite of the apple. Financially, that's not why you guys got into the business. What am I talking about now?
You want to take it?
Oh, cool. Yeah, when we're looking at any business, certainly in the craft space as well, craft brewery space, we're looking for competitive advantages. And a lot of things can be competitive. Distribution can be competitive advantage, whether that's rotating taps, whether that's shelf space. You've got great shelf space at the local Kroger. And you've got consistent events driving traffic to your facility. And we talked about tap rooms a moment ago. And out in, again, LA, I'm talking about going to an industrial complex in the back someplace where they got a roll-up door and they got all the great equipment that I can see. And we got a bar, we got some tables, and a food truck. And that's cool. That's Friday night. I like it. We're good. And I can go to 5 different ones and I can see nobody, and I can see standing room only. So really, what are you doing to drive traffic? Is it introduction of new product? Is it trivia night? Is it football? Is it bands? Whatever you're doing to cater to your audience. So understanding your audience and marrying up the audience your product talks to with the other things they do, so they can do more than one thing while they're with you, means they drink more beer while they're there. Good, all good stuff. Competitive advantages. Growth ability constraints. Cash is king. You have limited capacity constraints. It's hard to make infinite number of types of beer, an infinite number of kegs per day. It's hard to do these things. It all takes money. Managing that inventory, it's perishable. The fresher, the better. So making too much isn't always a good idea either. Being sold out means you can't sell it, so there's a balance in there someplace. Human capital, got to have strong leadership for the business itself, business acumen, as well as you got to have somebody who knows how to make a quality product. And whether you're ale or whether you're a pilsner or whether you're, whatever you're doing, more stouts, sometimes a stay in your lane conversation can be helpful because your brewmaster may not be the best pilsner guy, but he does great ales, or she does great malts or barleys, whatever you're doing, sours. Locations are important. You have kind of a radius you pull from for your customer perspective. Who comes to your location is 3 to 5 miles more than likely. You'll get some people that come from far away. They're fans, pretty detailed fans. But for the most part, there's somebody like you 4 miles away, 5 miles away, 10 miles that way, 3 miles that way, and you're all fighting for that balance in there. So getting distribution through grocery stores, liquor stores, rotating taps, and other places that have to sell alcohol gets you more awareness in a broader space, and people tend to come from a larger circle. And I think that's it. Balance sheet health.
Yep.
You're the CPA, you talk about balance sheet health.
Well, yeah. It kind of goes with the cash is king type, discussion there of, having the ability to fund operations on a weekly, monthly, annual basis, managing that balance sheet if debt's taken out or loans are taken out for equipment or, what have you, just a healthy company from a balance sheet basis is always going to be, attractive to buyers and also, be able to fund, the ability to grow, right? If you're kind of maxed out where you are already and you don't have room on your, within your kind of current financial structure to expand that way, it's going to be a little bit of a kind of a stalling situation. So I can kind of touch here. So this is another kind of valuation consideration is, we were talking about EBITDA earlier, and sometimes maybe that's not what a potential buyer is really after. It could be the brand, the name recognition of a certain couple beers, the distribution channels that you may have, things like that. But in terms of actual earnings and cash flow, right? There's something that is very commonplace in our world, but probably not to you guys, in that there are various costs, expenses that may be incurred that, when you look at a kind of go-forward basis, aren't going to happen, or they're one-time kind of, catastrophic events that occurred where all we're putting there is that there, in our world, we do our due diligence to figure out how to kind of normalize what you guys are doing, right? What's your normal, if you're doing X volume of sales in your various channels, what should that really get down to in a bottom line that doesn't have these kind of outlier events going on? And then, Tim, this is really your point. You want to talk about
Yeah,
the
sure.
bottom line
And
there?
that's an important point as you're building your business and you're talking about perhaps giving equity to people along the way.
Right.
1% of the business is not worth 1% of the value of the whole business. Businesses in our world, in Fred's world, businesses are marketable. If I own 100% of it and I decide to sell, I can sell. I can call a business broker, I can call an investment banker, I can get somebody in here to talk about selling my business and we can get it sold. Might take a year, but we can get it done. If I own 10% of your business and I want to liquidate and monetize my position, I call you up and say, hey, let's sell. I want to sell my 10%. And you go, yeah, no, sorry. And what do I have to do? I have to go find someone who's going to buy 10% of a business they don't know very much about. You don't have control, and you don't have the ability to market and force a sale liquidation event, and you have no ability to gain those things. So both of those create, in transactions that trade at a substantial discount. So if the business is worth $100, 10% would be worth $10. We typically see that chunk not trade for 10, but trade more for like 6 or 5. So we quantify those discounts. When we're doing your work for other purposes, we find ways to quantify those discounts, apply them, and come up to a conclusion, tax purposes or whatever. But when you're thinking about this, hey, I'm going to be giving shares to one of my employees, those shares might look like income from their tax return. It doesn't go over at 10% of the enterprise value. It goes over at something less, and they shouldn't have to pay quite as much tax. And voting shares have the same situation. We'll see high net worth individuals who will restructure their company, 1% voting, 99% non-voting, give the 99% to the kids. If it doesn't vote, it doesn't control. They get a discount for that, even though they're transferring almost all of the company. So there are ways to kind of structure that to take advantage of those discounts if you're in a tax environment that you need it. But generally speaking, if you're running your business with the intent of incentivizing your employees by giving them shares and ownership positions, you have to be careful how you do that. And Will's going to talk about ESOPs, which is one way down the road. But just from a straight gift or a straight non-cash compensation perspective, there are discounts applied. We'll skip through.
Yeah, we have. Well, I'll introduce these topics here. But again, as I kind of talked about earlier, this is not any of our 3 areas of expertise. But
That's Jeff Barrett. He's sitting right here.
yeah, that's right. The ghost of Jeff. But yeah, he had put together a list of kind of applicable tax topics for people in the industry. R&D tax credit, we actually have somebody that does that, but we'll see. But not to put him on the spot, but
Yeah, so I'll talk real briefly because I'm actually on an R&D tax credit seminar. I'm Dave Oxenhorn, I work at CBIZ as well. In our R&D tax credits group, we do a lot of R&D tax credit studies and work for breweries specifically because you guys are constantly coming up with new formulations for beers or improving your brewing techniques and processes, which is all qualifying for the credit. The only thing that's negative about the credit, they came into play starting in 2022, but even if you decide not to take the credit, you have to capitalize those costs. So let's just say we identify wages of employees, the supplies for our ingredients, and maybe some contractors we work with to come up with some new processes, or maybe even our recipe formulations. You don't get immediate deductions for those costs now. It gets amortized over a 5-year period. So it's punitive in that respect. It's a timing difference. So you'll get the credit, which is dollar for dollar reduction of tax, so that's beneficial. But you have that upfront kind of halt of the expense. It's required even if you don't take the credit. But we do kind of have some people that kind of put blinders on if they haven't taken the credit before, said, hey, listen, we're just doing core beers and we're not really in an R&D standpoint. So that's kind of like the offset. There's been bills and propositions to repeal that law and make it favorable again. That's kind of halted. The new administration is busy with tariffs and other stuff, as we can see. So hopeful that goes away, because it is very powerful, especially for breweries. You know, no matter what size, you can get that credit, and it'll help offset taxes for you guys. So that's a quick spiel like this, right?
thanks, Dave. He didn't know, by the way, that I was going to kick this over to him, but appreciate it. Got some other good stuff on here. The ability to, you guys buy equipment, the ability to depreciate it quicker and essentially, drop all that expense to reduce your tax liability. There's work opportunity tax credit, hiring individuals such as veterans or disabled people. There's kind of a income tax relief there as well. Inventory management and costing strategies. This would really be kind of Jeff's area, not mine. But just there's some planning and kind of finagling, if you want to call it, there that can be done to kind of result in some savings. Cost segregation study. Not similar, but also dealing with a kind of accelerating depreciation and getting that, dropping that expense to your bottom line earlier than later, which ultimately is a good thing, right? Reduce your taxes as soon as you can. Reducing them now is better than, getting the benefit of that 10 years from now. There's an excise tax credit there. And then just some other opportunities in terms of entity structuring. If you guys own the real estate that your breweries operates on and things like that, with kind of having them split out into different entities, and certain leasing arrangements and things like that can sometimes be tax advantageous. All right, so this is kind of my area where I live 90-something% of the time. So ESOPs, so it stands for Employee Stock Ownership Plan. Essentially, what they allow a business owner to do is to sell a portion, whatever portion they want, 30%, 51%, 100%, essentially back to their employees. And this is, it results in usually leverage for the transaction to be put on the balance sheet, and then essentially kind of paid off over time. And then as those payments go, the employees are allocated shares, similar to it's essentially a retirement benefit, where over time they're getting allocated these shares that are held in suspense once you sell them to a trustee who acts as the buyer on behalf of the employees. Again, a primary advantage of this is it allows an owner to sell whatever stake they want, right? A lot of times, and as Tim was talking about a minority sale, it's tougher to go find a buyer or somebody willing to buy a minority interest, whereas within the ESOP world, as long as it makes sense from, it's a good solid company with a good foundation, there's always that willing buyer with the trustee who will, purchase whatever percentage is desired by the business owner. For the selling shareholders, there's significant tax advantages. There's potential to defer or eliminate entirely capital gains tax. So, try to put simply, anything that you sell your company above what your tax basis is, you're gonna have to pay a capital gains tax on. And there's the ability to kind of defer that in any ESOP transaction. And then kind of get back to the sale of minority interests where Tim had talked about, hey, yeah, if you sell company's worth $100, you sell 10% of it, you're not getting $10, you're getting $5 or $6. In the ESOP world, you're going to get close to that 10. There's not that discount associated with it. And from getting away a little bit from the kind of financial advantages, from a culture and company advantage as well, you're retaining the employees. Your company operates the same post-transaction as it did pre-transaction. There's no immediate shift. The trustee that's going to come in and be the buyer is not going to run your brewery. They are just, have a fiduciary responsibility to the employees that they're buying the company on behalf of to make sure that things aren't going off the rails, right? The selling shareholders are the ones that, they control the company and run the company before the deal, and they do the same thing after. It's different than a private equity deal, which can obviously take a bunch of different forms, or a sale to a strategic buyer, which, they may want you to come in and run your company exactly how it was. Great. That may not be the case. It may be that it's rolled up and they may say, we don't have a need for XYZ positions. We're gonna, fold the brand, we're gonna fold your guys' signature beers into our brand and things like that, where in an ESOP transaction, that would not be the case. Again, everything exists as it did prior, after the acquisition as well. It's a way to reward long-term employees with employee ownership. Again, it's not a trustee buys the company on behalf of the employees. Now all the employees have all the equity that you've sold. It's meant to be a long-term mechanism, which is releasing shares on an annual basis to the employee base, and in theory, your company value is getting higher throughout the years as well. So as an employee, they've incentive to stay on, help grow the company, profitability, and they get that benefit of they're seeing their shares, the balance of their shares increase, and hopefully that share price increasing as well. So similar to if you get onto your brokerage account and it's just a simple, generally just a simple, hey, what's the price times how many do I own? And that's my value, and they can kind of see the impacts, on a year-to-year basis. See here, employees. We kind of talked about. I get one key thing here is, and it's often it's a very good question. Is hey, in an ESOP transaction, are the employees are they contributing any? Is it like a 401k match type thing? That is not how this is set up. It's a benefit they're getting every year without anything requiring a contribution of them. It's simply, hey, they're getting shares allocated every year, and again, multiplied by that stock price, and they can kind of see that value grow. And typically we see, for companies, regardless of industry, if they have other, retirement benefits, they'll a lot of times keep those intact, and then, be able to market being an ESOP-owned company as an advantage, a competitive advantage when they're going out. Well, one, trying to retain your good employees that you want to, keep on board, and then also going out and market and trying to attract new hires has proved to be a leg up there. And again, it just kind of allows employees or incentivizes employees to adopt an ownership mindset, because they are truly the ones that are going to reap the benefit, right? It's a kind of a tangible a thing there. It's not just a nebulous, well, we want you to work hard and help the company grow, and like nobody really knows what that means. Actually be able to see that in real time and actually see some numbers associated with it. And then just ESOP, I think it's our last ESOP slide here, ESOPs in the craft brewery industry. So see some transactions there that have happened, like obviously a huge one, New Belgium formed an ESOP in 2000, and so I think they did a minority deal, maybe 30% or whatever, what have you, and then they eventually worked their way up to being fully employee owned by 2012. And then they actually sold in 2020, but the kicker here is that who's the owner now? It's the employees. They're getting the payout, right? So it's what I think is an overlooked thing in the ESOP world a lot of times is like there's so much flexibility. You can sell to an ESOP, the company's on a great trajectory, and the trustee working out as a fiduciary on behalf of the employees, that's all they're concerned about. What is best for the employees. They're not trying to run the business, but if the management team comes to a trustee and says, hey, we think we can, sell, we think we can get a great deal, above kind of, what otherwise the share price of the company might be, the trustee is usually going to say, sounds great, that's great for the employees. If we're valuing the share price here and somebody's going to come in and pay this, that's a boon to the employees, and they're the ones that are getting paid out. So it's not, something where you sell to an ESOP and then it's got to stay intact like that forever. There's a lot of, ways that it can be a benefit, and it doesn't have to be that an ESOP operates as it did for 50 years. We see circumstances like this in a lot of different industries. So I think I talked about that enough. I think that stuff on the right is kind of stuff we talked about already. And I think maybe we just have one more slide. I don't know if, Brett, if you want to take this one and just general kind of exit considerations.
Yeah, so out of curiosity, who has had an opportunity to maybe be exposed to an ESOP or had some understanding of ESOP, but just, okay, everyone else kind of first time you're hearing, okay. The reason I'm asking is because it is related to your exit strategy, right? We talked about valuation. We talked about, you saw some transactions from an M&A standpoint, but even though in my world, I focus 100% of my time on M&A. I don't focus on ESOP whatsoever. But every time that I'm having a conversation with a business owner that's looking to exit, I try to lay out to guys, look, these are your options, right? ESOP being one of them. And there's no right or wrong. I think Will did a great job demonstrating the positives. But there may be some drawbacks. One that you may have a different view of, but I believe that generally speaking, from a value standpoint, you probably get a little bit less to go the ESOP route versus you sell out the market through an M&A transaction, right? But again, it's all about your specific case, your strategy. And the other thing too that, I don't know if you touched on that, but on the ESOP side, you need to have a really solid team, right?
Yep.
I don't know if you want to talk about that.
Well, yeah, because it's a great point. For a third-party M&A deal, a lot of like you're talking about, a lot of times they're folding you into something, and it may not need these high-level kind of leadership positions because they've already got that in their platform company or they're a strategic buyer, their own kind of leadership team, right? With an ESOP, again, is the great thing about a trustee not wanting to run your company. They are also wanting to make sure that the selling shareholders or the management team, if the selling shareholder is coming up on retirement and they want to kind of get their payout and sail off into the sun, that's okay. However, you need to have the next level of leadership coming up behind them.
Yeah, they want to feel comfortable with that. The company's going to run itself, not going to run to the ground, but it's going to run itself, right? So I always say, don't try to time the market. If we look at M&A activity, I've been doing this for a while. I'm going to date myself, but I started in M&A in 2006, right? 2006, 2007, leading to the 08 crisis, was the peak of M&A activity. I thought I was never going to see that again in my entire life until 2022 came. In 2022, again, there was just, I couldn't believe it. I'll see. It was like deja vu, crazy activity, multiple sky highs, and so on and so forth. And then 2023 leveled down, 2024 kind of eh. And then we started 25 in really good mood, everyone, until, you know, tariffs and all this thing that's going on. So don't try to time the market, because how are you going to know? How are you going to know that, okay, this is the year to sell? By the time you figure that out, were you ready to sell? We particularly focus primarily on 3 areas. One is the buy-side diligence. So someone is interested in buying you guys out, they'll hire me. I'm going to do diligence on you guys and report back to the buyer. They'll make a decision. The other one is the sell side, meaning you've decided to sell. You're done. You're over, and you put it in the market today. And let's say you hire an investment bank or a broker. I'll talk a little bit more about that. They'll say you got to have a sell side quality of earnings. That's going to give you confidence. I'll come in, I'll do that, and they'll go out and try to sell the company. And the third one is the exit readiness. It's when you're looking to exit 1 to 3 years down the road. Okay? And that's what I'm going to focus a little bit more here. So you can't time the market, and you can have all different unforeseen events, right? Death, disability, divorce, then we've seen our shares of, you know, having to sell or figure something out because of divorce, disagreement with partners, distress situation. You don't want to sell your business when you're not in good shape, right? That's the worst time. So consider all options, whether you want to sell outright, you want to sell a minority to get some chips off the table, but you want to stay in the business, an ESOP or a management buyout, and try to, from that point on, you got to be reasonable, right? Sometimes I'll plan meet your that. You may want to, you know, I'm going to do an ESOP, and then 2 years down the road, not going to work out. But start understanding, just like you're doing now, right? You get a little bit of knowledge, talk to people, try to understand the different options, and start thinking through. I've always said that you should run your business the same way as a private equity firm would. Sometimes when I say that, people get like, no, I hate private equity. I said, what I mean is, when a private equity acquires a business, from day one, they start tracking everything. They start tracking your EBITDA, your one-time adjustments, all of that. And they have all their monthly KPIs, not just at year-end when you close the books, monthly. All your revenues, your costs, your production, every single thing goes in the monthly basis. And run it as if, God forbid, tomorrow you got to sell it. And then you're ready. You're truly ready, right? Maintain clean books and records, which is part of that. Carefully track all your KPIs. It was interesting this morning when that lady at the marketing was talking about an example of a client for, I don't know, many years tracking everything in Excel. And we see a lot of that, unfortunately. Right? There's poor systems or no systems. So make sure you track that. And then build an advisory team that truly understands M&A. Again, sometimes people, you know, I have this buddy of mine that I've known forever who's a lawyer. He's a estate planning lawyer, but he's giving me advice. Well, if he's a estate planning lawyer, odds are he really doesn't understand M&A. So find a good lawyer that truly understands M&A. Find someone on the accounting and finance side that truly understands M&A, that lives and breathes M&A, right? So build yourself a team. If you have a wealth management advisor, start having these conversations, because that's how you're going to eventually prepare yourself and exit, hopefully on your own terms, not on someone else's terms.
Great. Good.
Okay, go ahead.
Yeah,
so,
yeah, go ahead.
go back one slide here. One of the things that we focus a lot is on this part right here. Maintain clean books and records. I don't have enough time today to go through all of it, because I can talk about that for days. It's one thing that I do for a living, and I'm very passionate about. There's a huge difference between maintaining clean books and records for tax purposes, for for an audit, if you audit or review financials, and for an M&A transaction. Very different concepts, right? I come across every now and then people come and say, oh, my company is audited. I'm very clean, I'm audited, and buyers will love it. I've been doing this for 20 years. Top 5 worst deals in my life that I want to jump off a building. It was just a living nightmare for 6 months. It was a company that was audited by a Big Four, one of the top global accounting firms in the world. And it was just a nightmare. Like, I can't even describe the kind of thing that we saw, okay? So just because you're audited, just because you're audited by a global accounting firm, that's a different story. And part of that process, I just gave you kind of a hint, right? It's running a monthly basis, on a monthly basis, your books, understanding everything goes wrong that's going in your business, understand what's driving sales, what's driving your gross margin, what's driving your operating expenses. Oops, I had a huge expense here this month that it's unusual, right? Whatever happened, something broke or I had to fix that. You know what? I'm gonna, as I'm calculating my EBITDA down here, I'm gonna give myself credit for that and start tracking all this stuff. Don't get caught up on multiples and multiples alone, because I had not a friend, an acquaintance that he was thinking about selling his business, and I was trying to have a conversation with him, and he seemed to know it all, and he goes, no, I know all my friends in the industry, we go for a multiple 7. I go, 7 times what? EBITDA. I said, okay, how about this? What if I can get you someone that's going to pay 9 or 10? Oh yeah, I'll sell it. What I gotta do is drive down the other side of the equation, right? So, you know, and we see this all the time. Private equity are expert on that, right? They say, oh, you have an EBIT of 5, multiple 7, 35. Then they go in, you aren't ready for due diligence, and that 5 becomes 4 or 3. And then you're like, wait a second, so what, still a multiple 7? Tell you what, I'll go up 1, I'll set a multiple of 8. And now you're all excited, got a multiple of 8, but they drove down, they still getting less money. Right? So don't get caught up. Use that multiple if you get words, just sort of like a bit of a north, but don't get caught up on that. Right? I think we're coming up
I think
fine.
we're right on time. Yeah. Appreciate everybody's. Yeah.
Is there anything outside?
No, this is basically the last thing on the questions.
We're hoping that you guys have any questions. I know we're out of time, but we'd love to. We'll stay here, but if you guys have any question when I ask now, please do so. I know someone out there has a question.
Have you had much pushback from the state liquor boards on ESOPs for the transactions, because there's all the nuances of how they want ownership? So have you seen much, or have they been pretty good to work with?
Yeah, that's a good question. I personally haven't closed any deals with craft breweries or kind of in the industry, so I would probably have to check in on that. But there are some times where there's different industries that have a few more hoops to climb through because it's not a traditional M&A transaction. But no, I would need to. And a lot of times I think it might be a state-by-state thing as well. So I don't know if I have an answer for you, but it's a very good question and definitely a consideration of, usually in the ESOP world, it's as long as we can get the company, like Fred's point, the company's in a good spot, there's that willing buyer, but there could be potentially some red tape in terms of actually getting it closed in that. So, yeah, it's definitely a consideration, and I wish I had the answer for you, but.
Okay, that's helpful. Thank you.
Yeah.
Well, and you know enough ESOP attorneys, we can find the answer.
Correct, yeah. Yes.
And in terms of these slides, if anybody wants them, just give Will your business card or whatever, email address, and we're happy to send them. Yeah.
Any other question?
Yes.
All right.
Thanks, guys.
Thank you,
We're ready.
everybody.
You want to come up and ask a question?